Here's the brutal truth that will save your trading account. 90% of retail traders lose money not because they can't analyze charts, but because they fight the one force that could make them rich, the trend itself. They buy falling knives, short rising rockets, and wonder why their accounts bleed red month after month. This isn't about intelligence or education. Harvard MBAs blow up accounts just as fast as high school dropouts when they argue with momentum. You see amateurs every day, convinced they're smarter than the market. They spot a stock down 30% and think, bargain. They see a momentum leader up 50% and think, overvalued. They trade their opinions against the tape's reality. Meanwhile, professionals do something that looks almost boring. They wait, watch, and follow. The difference isn't talent, it's identity. The amateur's mindset is poison disguised as wisdom. They believe contrarian thinking makes them sophisticated. Be fearful when others are greedy. They, quote, completely missing Buffett's context. They see a stock crashing from $80 to $50 and think they've discovered hidden value. Their ego whispers, everyone else is panicking, but I can see the real worth. This intellectual arrogance has destroyed more trading accounts than any technical indicator ever could. Consider the amateur during March 2020. They watched airline stocks collapse 70% and started buying the dip at every level. Delta at $40, then $35, then $28, then $18. Each purchase felt logical. How much lower could airlines go? They averaged down with mathematical precision, turning a small loss into account-threatening devastation. Their spreadsheets showed brilliant analysis. Their account statements showed brutal reality. The professional watched the same carnage with different eyes. They saw broken support levels, institutional selling, and momentum accelerating to the downside. No opinions about airline fundamentals, no predictions about recovery timing. Just pure observation. The tape showed weakness, so they either stayed flat or joined the selling pressure. When the trend finally reversed, months later, they waited for confirmation before participating in the recovery. This psychological chasm runs deeper than most realize. Amateurs need to be right about direction to feel validated. Professionals need to be profitable to stay in business. Amateurs predict. Professionals react. Amateurs hope. Professionals confirm. These aren't just different strategies, they're completely different identities operating in the same market. Jesse Livermore understood what most traders never will. At 21, he made his first fortune doing one thing religiously, trading only with the dominant trend. When the tape showed strength, he bought more. When it showed weakness, he sold or went short. No predictions, no opinions, just pure alignment with the market's revealed direction. This wasn't passive. Following it was active obedience to market forces bigger than any individual participant. Livermore's genius emerged from painful losses, not natural talent. Early in his career, he tried to outsmart the market through fundamental analysis and contrarian thinking. The market taught him humility through repeated account destruction. He learned that fighting the tape was like arguing with gravity. You might win a battle, but physics always wins the war. His breakthrough came during the 1901 Northern Pacific corner. Instead of trying to predict the outcome, he simply followed the price action. When panic selling began, he shorted. When short covering started, he covered and went long. He made money on both sides by abandoning his need to be right about the underlying situation. The market paid him for obedience, not intelligence. This approach violated every instinct about smart investing. Buying strength felt like chasing. Selling weakness felt like panic. But Livermore discovered that feelings were unreliable advisors in markets driven by institutional flows and mathematical algorithms. The tape told the truth. Emotions told stories. He chose truth over comfort, profits over pride. Here's the promise that will revolutionize your trading. You'll make more money by trading less. Waiting is a position. The market pays those who move with momentum and punishes those who argue with it. This violates everything you've been taught about finding bargains and being contrarian. It feels wrong because it is wrong in every other area of life except financial markets. Think about 2008, the year that separated professionals from pretenders. Amateurs saw Citigroup falling from $50 to $30 and loaded up on cheap shares. They watched it fall to $20, then $10, then $5, then under $1. Each decline felt like validation that they were getting an even better deal. They were catching falling knives with their bare hands, and they couldn't understand why they kept getting cut. Professionals operated from an entirely different framework. They recognized that markets move in trends for fundamental reasons that often aren't immediately apparent. When a stock is falling hard, there's usually information that smart money knows but hasn't been fully disclosed. When a stock is rising persistently, there's typically underlying strength that institutions have already identified. The mathematics of trend following create its edge. Trends persist longer than most people expect because they're driven by forces that take time to fully play out. Corporate earnings don't change overnight. Economic cycles unfold over months and years. Institutional positioning shifts gradually, not instantly. When you align with these forces instead of fighting them, you tap into the same dynamics that move billions of dollars through global markets every day. Picture two traders watching the same chart in real time. GameStop is breaking above $20 after weeks of consolidation around $15. The amateur thinks, I could have bought it at $4 last year. This is way too expensive now. The professional thinks, the weekly chart shows a clear uptrend. Daily consolidation is holding above support. If it breaks $20 on volume, institutions might be accumulating. The amateur passes, waiting for a pullback that never comes. The stock runs to $30, then $50, then beyond rational valuation. The professional enters on the $20 breakout, adds on the $30 consolidation break, and exits when momentum finally stalls. Same chart, same information, completely different outcomes based on identity and approach. Or consider the inverse scenario. A former market darling starts breaking down after missing earnings. It falls from $100 to $85, and the amateur thinks, 20% discount. They buy, hoping for a bounce back to $100. The professional sees broken support, institutional selling, and momentum accelerating downward. They either stay flat or consider shorting if their system generates a signal. The stock continues falling to $70, then $55, then $40. The amateur averages down at each level, turning a small loss into a devastating blow. The professional either avoided the damage entirely or profited from the decline. The difference wasn't luck or insider information. It was systematic obedience to trend-following principles over emotional attachment to opinions. Livermore discovered a specific pattern that appears in every major move, from the 1907 panic to today's markets. There's a secret timing mechanism, a pivotal point system that most traders completely miss. This isn't about predicting, it's about recognizing when the market screams go versus when it whispers wait. The pivotal point concept revolutionizes how you view market action. Instead of trying to pick tops and bottoms, you wait for the market to show its hand. You let price action confirm direction before committing capital. This removes the guesswork and replaces it with objective evidence that institutions are moving in your direction. Here's how this plays out, in real time. A stock has been in a clear uptrend, making higher highs and higher lows for months. Suddenly, it starts to consolidate, forming a sideways pattern after a significant advance. Amateur traders see this consolidation and immediately worry that the trend is over. They start taking profits or avoiding new positions. Professional traders see the same consolidation, but interpret it differently. They identify the key resistance level that caps the recent sideways movement. Only when price breaks above this level with authority and volume do they consider entry. They're not trying to predict when the breakout will occur. They're waiting for the market to prove that accumulation is complete, and the next leg higher is beginning. The amateurs see a breakout and think they've missed it. The professionals see the same breakout and recognize the beginning of something much bigger. This fundamental difference in perspective explains why some traders consistently profit while others consistently lose. The breakout isn't the end of the opportunity, it's often just the beginning of the real move. Understanding this concept changes everything about how you approach trading. Instead of trying to get in at the exact bottom, you focus on capturing the middle portion of major moves. You're not trying to be perfect, you're trying to be profitable. You're not trying to predict the future, you're trying to profit from the present momentum that institutions are already creating. The beauty of trend following lies in its simplicity and mathematical edge. You don't need to predict earnings surprises, anticipate Federal Reserve decisions, or forecast economic conditions. You simply need to read the tape correctly and position yourself accordingly. The market's own momentum carries your positions to profit when you're aligned correctly. In the next few minutes, I'll show you exactly how to identify these pivotal moments and why the biggest profits come to those who buy. Strength, not weakness. You'll discover the specific signals that separate meaningful breakouts from false moves, and you'll learn why your natural instincts about market timing are probably sabotaging your results. Most importantly, you'll understand why trading with the trend isn't just a strategy. It's the only sustainable path to long-term trading success that doesn't depend on being smarter than institutional money managers with unlimited resources and superior information. Most traders think they understand trends, but they're looking at the wrong time frame. They see a stock up 5% today and call it an uptrend, or down 3% and declare it broken. This microscopic view destroys accounts faster than any other mistake. It's like trying to navigate across the ocean using a street map. The scale is completely wrong for the journey you're attempting. Amateurs stare at 5-minute charts, watching every tick, convinced they're seeing meaningful patterns. A stock gaps up 2% at the open, and they declare a new uptrend has begun. By lunch, it's given back the gains, and they're confused why their trend-following trade failed. They're not following trends, they're chasing noise disguised as signal. Professional traders operate from an entirely different framework. They understand that real trends unfold over weeks, months, and sometimes years. They're not interested in today's 3% move. They want to know what institutional money has been doing for the past 3 months. They're not trading the headlines. They're trading the underlying structural forces that move billions of dollars through markets every single day. This fundamental difference in perspective explains why some traders consistently profit, while others consistently lose, even when looking at identical price action. Here's Livermore's first rule that built his fortune. Define your campaign time frame, then demand alignment across multiple horizons. Your campaign time frame is the chart you primarily use for entries and exits daily for swing traders, hourly for active day traders, weekly for position traders. But this time frame cannot exist in isolation. If you're swing trading on daily charts, the weekly must agree. If the daily shows higher highs and higher lows, but the weekly shows lower highs and lower lows, you have no trade. Period. This isn't a suggestion. It's the foundation that prevents 80% of losing trades before they happen. Livermore learned this lesson through brutal experience during his early years. He would identify what looked like perfect setups on shorter time frames, only to watch them get crushed by larger forces he hadn't considered. A stock breaking out on the daily chart would get demolished when weekly resistance held firm. An apparent reversal on the hourly would fail when the daily downtrend remained intact. The breakthrough came when he started thinking like the institutions whose money actually moved markets. Large funds can't trade based on 5-minute charts. Their position sizes are too large. When they accumulate or distribute, it shows up over weeks and months, not minutes and hours. By aligning his analysis with institutional time frames, he started profiting from the same forces instead of fighting them. This multi-time frame approach eliminates the amateur's biggest weakness: mistaking temporary counter-trend moves for genuine reversals. When you demand alignment, you automatically filter out the head fakes and false signals that destroy most trading accounts. You're not trying to catch every wiggle, you're positioning for moves that have institutional backing and staying power. Picture this scenario that played out thousands of times during 2022's bear market. A trader spots a former high flyer that's been decimated, down 70% from its peak. The stock bounces 8% off what appears to be a major low. The daily chart looks bullish, higher low established, volume surging on the bounce, momentum indicators turning positive. He buys with conviction, risking 2% of his account on what seems like a textbook reversal setup. His analysis feels solid, his risk management appears proper, and his timing looks perfect. But the weekly chart tells a completely different story. 6 months of relentless selling pressure, lower highs every single week, institutional distribution, clearly visible in the volume patterns. The long-term moving averages sloping downward with no signs of stabilization. What looked like a reversal on the daily was actually just a temporary pause in an ongoing institutional liquidation. The 8% bounce becomes a negative 25% loss over the following 3 weeks, as the weekly downtrend reasserts itself with vengeance, taking the stock to new lows. Now, contrast that with a professional's approach to the identical situation. She sees the same daily bounce but refuses to act on it alone. She examines the weekly chart and immediately identifies the misalignment. Daily trying to turn bullish, weekly still clearly bearish. According to her protocol, this means no trade exists, regardless of how compelling the daily setup appears. She waits. Weeks pass. The stock continues its weekly downtrend, making new lows exactly as the weekly chart suggested it would. She feels no regret about missing the daily bounce because her system told her it was a false signal from the beginning. She saved her capital for opportunities where both time frames agree on direction. When alignment eventually occurs, perhaps months later, when both daily and weekly charts show higher highs and higher lows, only then does she consider entry. Even then, she starts with a small position, maybe 0.5% risk. She's not trying to maximize profit yet. She's positioning for confirmation that both time frames are indeed working together. Here's your protocol that will eliminate most losing trades before they start. First, identify structure on your primary trading time frame. Uptrend equals higher highs and higher lows. Downtrend equals lower highs and lower lows. Sideways equals neither pattern clearly established. This isn't complicated, but it must be objective and consistent. Use structure, not feelings. An uptrend is a sequence of higher highs and higher lows that holds above rising moving averages. A downtrend is lower highs and lower lows, living under declining averages. Second, confirm alignment on the next higher time frame. If you're trading daily charts, check the weekly. If you're trading hourly, check the daily. The higher time frame doesn't need to show the exact same pattern, but it cannot be in direct opposition. A daily uptrend can work with a weekly sideways market, but not with a weekly downtrend. Label the trend on both time frames, then verify the labels don't conflict. Third, if they disagree, waiting is your position. No exceptions, no rationalizations. No, this time is different thinking. Disagreement between time frames means institutional money is conflicted, or the larger trend is still in control. Either way, the odds are stacked against you. This protocol feels restrictive at first, because it eliminates so many potential trades. Amateurs see this as missing opportunities. Professionals understand they're avoiding disasters. Let's put numbers on this process. Suppose you run a $100,000 account and cap single trade risk at 0.5%. That's $500. Your daily chart prints a pullback within a confirmed weekly uptrend. Your entry trigger is a buy stop above recent resistance, and your stop loss sits below recent support. The distance between entry and stop is $2.50. So position size is $500 divided by $2.50 equals 200 shares. If the weekly flips against you during setup, you cancel the order and reassess. No exceptions. Here's what separates amateurs from professionals: patience during the setup phase. Most significant trends begin with accumulation that looks like absolutely nothing is happening. Volume dries up, price moves sideways in a tight range, excitement disappears completely. The financial media stops covering the stock. Retail traders lose interest and chase action elsewhere, drawn by the siren song of volatility in other names. Professionals recognize this boring phase as smart money quietly building positions while weak hands have been completely shaken out. Institutions can't buy millions of shares all at once without moving the price dramatically, so they accumulate slowly, methodically, often over weeks or months. This creates dull, sideways patterns that most traders dismiss as dead money. But this consolidation is actually the market building a foundation for its next major move. Consider how Amazon traded from 2014 to 2016. After a massive run, the stock entered a 2-year sideways consolidation that looked like nothing was happening. Day traders abandoned it for more exciting momentum plays. But weekly charts told a different story. Consolidation was holding above key support levels, and volume patterns showed institutional accumulation during every dip. When Amazon finally broke out in 2016, it wasn't a surprise to professionals. The breakout led to a 300% gain over the following 2 years. Volume patterns provide the final piece of the alignment puzzle. When time frames agree on direction and volume confirms institutional participation, you have the highest probability setups available. During genuine accumulation, you'll see volume expand on upward moves and contract on pullbacks. This creates setups that work 65–70% of the time, with average winners significantly larger than average losers. The maxim that will save you thousands. Alignment before action. You don't earn the right to enter until both time frames say go. This single rule eliminates more losing trades than any other concept in technical analysis. But knowing the trend isn't enough. You need a trigger that forces the market to prove itself. Next, I'll show you the exact moment to pull the trigger. Livermore's pivotal point system that turns patient waiting into profitable winning. Timing separates the wealthy from the hopeful. You can be right about trend direction and still lose money if you enter too early or too late. Livermore solved this with what he called the pivotal point, a specific price level where the market proves its intentions beyond doubt. This isn't about prediction or analysis paralysis. This is about letting the market ring your doorbell before you open the door. Think of it like boarding a moving train. Jump too early, and you fall under the wheels. Jump too late, and you miss the ride entirely. The pivotal point is that brief moment when the platform door opens, and your job is to step through only when it opens, not when you wish it would. Here's how amateurs destroy themselves with mechanical precision. They see a stock in a clear uptrend, pulling back 10% from recent highs. Fear of missing out drives them to buy the dip immediately. No confirmation that the pullback is over, no proof the selling pressure has exhausted itself. Just raw emotion disguised as value hunting. They convince themselves they're being smart by buying weakness in a strong trend. The stock continues falling another 15%, triggering their stop loss just before institutional buying finally emerges and the real move begins. They get whipsawed out at the exact worst moment, watching from the sidelines as their original analysis proves correct but their timing proves costly. Picture this scenario from early 2022. A trader spots a former growth leader that's been decimated, down 60% from its peak. The stock bounces 8% off what appears to be major support. The daily chart looks bullish, higher low established, volume surging on the bounce, momentum indicators turning positive. He buys with conviction, risking 2% of his account on what seems like a textbook reversal setup. But he's buying hope, not confirmation. The stock continues its decline, falling another 25% over 3 weeks as the larger downtrend reasserts itself. His analysis of the bounce was correct, but his timing was premature by several months. Professionals wait for the pivotal point, the moment when price reclaims a meaningful level, with authority and volume confirmation. Picture a stock that's been trending higher for months, then consolidates for 2 weeks between $45 and $48 after a significant advance. During this consolidation, the amateur sees confusion or boredom. The professional sees a critical testing ground, where institutional money decides whether to continue accumulating or begin distributing. That $48 level becomes your pivotal point because it represents the line between continuation and failure. Above $48, the uptrend remains intact and institutions can continue their campaign. Below $45, The trend structure breaks and selling pressure may accelerate. You don't guess when it will break. You wait for the market to show its hand. This waiting isn't passive, it's an active, disciplined stance that filters out countless false starts and whipsaws. The pivotal point acts as final confirmation that the larger trend is reasserting itself, and the risk of immediate failure is significantly reduced. This patience saves you from buying temporary bounces within larger downtrends, a mistake we discussed regarding multi-time frame alignment. The beauty of this system lies in its objectivity. There's no interpretation, no gut feelings, no complex calculations. The market either breaks the pivotal point with volume, or it doesn't. Price either follows through immediately, or it doesn't. These binary conditions eliminate the gray areas where amateur traders get trapped by wishful thinking. Here's your entry protocol that transforms waiting into winning. First, identify the last meaningful swing high that capped the recent pullback or consolidation. That's your pivotal point. This level should be obvious on the chart, not some obscure price requiring complex analysis. If you're struggling to identify the pivotal point, the setup probably isn't ready yet. Second, place a buy stop order 10 to 20 cents above that level. The exact buffer depends on the stock's volatility and average spread, but it should avoid random noise while catching genuine breakouts. Third, when your buy stop triggers, demand immediate follow-through. The stock should continue moving in your direction within the first few minutes or hours after entry. If price breaks the pivot then immediately reverses back below it, you exit the entire position without hesitation. No second chances. No let me see what happens. No hoping it was just temporary weakness. The market just told you that institutional buying wasn't ready to support higher prices. Your initial stop loss goes below the should not be breached level, typically the recent swing low that started the current move toward your pivotal point. This creates logical risk management, where your stop represents clear violation of the trend structure you're trading. If that level breaks, the entire setup is invalidated. Risk only 0.5 to 1% of your capital on this initial probe. Calculate position size using this formula. Risk amount divided by entry price, stop price, equals share size. If you're risking $750 on a trade with a $4.70 stop distance, you buy exactly 159 shares. The mathematics remove emotion from position sizing decisions. Position size equals risk amount entry price, stop price. Position size equals entry price, stop price risk amount. Let's walk through a complete example. Your account is $100,000, and you limit single trade risk to 0.75%. That's $750. You identify a pivotal point at $52 in a stock consolidating between $48, $52 for 2 weeks. Your buy stop goes at $52.20 to avoid false breakouts. Your stop loss sits at $47.50, just below recent support. The risk per share is $52.20. $47.50 equals $4.70. Your position size becomes $750 divided by $4.70 equals 159 shares. You place the order and wait for the market to trigger your system. I studied Livermore's 1,907 trades extensively, and his Union Pacific position illustrates pivotal point mastery perfectly. The stock had been consolidating around $160 after a significant advance, creating clear resistance that capped several rally attempts. When Union Pacific finally broke above its pivotal point at $162 on massive volume 3 times normal daily average, Livermore didn't hesitate. He bought with both hands as the tape confirmed genuine institutional buying pressure. The volume surge wasn't random noise. It was smart money positioning for something bigger. The stock ran to $196 in 6 weeks, gaining over 20% and validating his patient approach. His edge wasn't prediction or inside information, it was systematic obedience to confirmation signals that revealed institutional intentions. He didn't try to guess when the breakout would occur or predict how far it would run. He simply waited for proof, then acted decisively when proof appeared. This trade demonstrates the power of letting the market prove itself before committing capital. Livermore could have bought Union Pacific at $155, $158, or $160, trying to anticipate the breakout. Instead, he waited for $162 plus, with volume confirmation, paying slightly higher prices in exchange for dramatically higher probability. The few extra dollars he paid for confirmation were insignificant compared to the confidence and follow-through that confirmation provided. Volume provides the final confirmation that separates real breakouts from false moves. When price breaks a pivotal point on volume 150 to 200% above normal, institutions are likely participating. When the same level breaks on light volume, it's probably retail speculation that will fail quickly. Livermore always demanded volume confirmation because real moves require real money, and real money shows up in volume patterns. Here's the counterintuitive part that trips up most traders. The best entries often feel uncomfortable. When that pivotal point breaks and volume surges, every instinct screams, too late. The stock is already up 2 to 3% from the breakout level. It feels like chasing, like you've missed the move, like you're buying at the worst possible moment. These feelings are natural, but completely wrong in trending markets. Professionals know this discomfort signals opportunity, not danger. The uncomfortable feeling means retail traders are hesitating while institutional money is accumulating. It means weak hands are worried about buying strength, while smart money is positioning for continuation. The very discomfort that makes amateurs hesitate gives professionals their edge. They're willing to buy when it feels wrong because their system tells them it's right. Consider the psychology in real time. Amateur sees the breakout at $52.20 and thinks, I could have bought it at $48 last week. This feels like chasing. Professional sees the same breakout and thinks, the market just confirmed institutional buying above resistance. My system says go. The amateur lets emotions override evidence. The professional lets evidence override emotions. This fundamental difference in response to discomfort explains why some traders consistently profit while others consistently struggle. The maxim that built fortunes. Confirmation is your courage. Don't guess when trends will resume. Wait for proof. Don't predict when consolidations will end. Demand confirmation. Don't hope your timing is perfect. Let the market tell you when it's ready to move. Next, I'll reveal how Livermore turned these small, confirmed positions into massive winners through pyramiding, adding to strength, never weakness, and building campaigns that captured the full power of institutional momentum. Here's where amateurs commit financial suicide while professionals build fortunes. Position sizing. Most traders risk the same amount on every trade, treating a weak setup the same as a screaming confirmation. This guarantees mediocrity at best, bankruptcy at worst. They'll risk $500 on a marginal breakout with light volume, and $500 on a powerful momentum surge with institutional participation. This approach ignores the fundamental truth that not all setups are created equal. Some trades offer 60% win rates, with 2-to-1 reward-to-risk ratios. Others offer 75% win rates with 4-to-1 potential. Treating them identically is like betting the same amount on a coin flip versus loaded dice, mathematically insane but emotionally comfortable. The amateur's position sizing reveals their fundamental misunderstanding of market dynamics. They think consistency means risking identical amounts on every trade. They believe this approach manages risk and creates predictable outcomes. In reality, it creates predictably mediocre results. They're optimizing for comfort instead of profit, for psychological ease instead of mathematical edge. When they spot a former high flyer down 70%, bouncing 8%, they risk the same amount as when they see a confirmed, leader-breaking pivotal resistance on massive volume. This lack of discrimination silently kills accounts, ensuring that even when good trades appear, their impact gets diluted by countless poor ones. Livermore's genius lay in pyramiding, adding to positions only after the market paid him, never when it punished him. He understood that your biggest positions should be in your best trades, not your worst ones. This is the exact opposite of what most traders do when they average down on losing positions, throwing good money after bad in desperate attempts to reduce their average cost. Livermore's approach was mathematically sound and psychologically brutal. Let winners prove themselves by winning, then bet more on proven winners. The psychology behind this approach runs counter to every natural instinct. When a trade moves against you, every fiber wants to fix it by buying more shares at lower prices. When a trade moves in your favor, every instinct screams to take profits and lock in gains. Livermore discovered that both instincts are wrong in trending markets. Losing trades tend to keep losing because they're fighting larger forces. Winning trades tend to keep winning because they're aligned with institutional momentum. His pyramiding system turned small initial positions into massive wealth-building campaigns. Instead of trying to maximize profit on single trades, he built positions systematically as the market confirmed his thesis. Each edition required fresh confirmation, new pivotal point breaks, continued volume participation, maintained trend structure. He wasn't hoping trades would work. He was demanding they prove themselves at every step. Here's the pyramiding protocol that built his fortune. Start with your base position, 0.75% account risk, on the initial pivotal point break. This base size gives you room to add without creating dangerous concentration in any single position. When the stock moves 2 to 3% in your favor and begins consolidating at higher levels, start looking for the next pivotal point. The consolidation proves that institutional money is comfortable holding at these elevated prices, rather than immediately taking profits. If the stock breaks this new pivotal point with volume confirmation, add half your original position size. Immediately move your stop loss on the entire position, both original and added shares, to below the new, should not be breached level, typically just under the recent consolidation low. This converts open profit into structural protection while expanding your profit potential. Let's walk through the mathematics with precision. You're managing a $100,000 account and identify a pivotal point break in XYZ stock. Your 0.75% risk equals $750. You buy XYZ at $50.20 with a stop at $47, creating a $3.20 risk per share. Your position size becomes position size equals risk amount entry price, stop price equals $750, $50.247 equals 234 shares. Position size equals entry price, stop price, risk amount equals $50.20, $47, $750 equals 234 shares. The stock runs to $54, consolidates for a week between $53, $54.50, then breaks $54.50 on heavy volume. You add half your original size 117 shares at $54.60. Your new stop for all 351 shares moves to $52, below the consolidation low. Even if this new stop triggers, you protect a profit on your original shares while taking only a small loss on your addition. The key insight that separates winners from losers: only add when you're already profitable on that position. If your last addition is underwater, you wait. No exceptions. No rationalizations. No, the setup still looks good thinking. This single rule ensures you're adding to strength, not weakness. It prevents the amateur's trap of throwing good money after bad, while systematically building larger positions in your best-performing trades. This rule sounds simple but proves psychologically challenging. When your most recent ad shows a small loss, every instinct wants to help it by adding more shares at better prices. The logic seems sound. If you liked it at $54.60, you should love it at $53.50. But this thinking ignores the message the market is sending. If institutional money was truly committed to higher prices, why isn't the stock holding above your ad price? Professionals interpret underwater ads as early warning signals. The market might be telling them that timing was slightly premature, or that institutional support isn't as strong as initially believed. Rather than fighting this message with more capital, They wait for the position to return to profitability before considering additional shares. Here's the psychological torture that destroys most traders watching a winner pull back after you've added to it. Your natural instinct screams, "Take profits." The position that was up $2,000 yesterday is only up $800 today. Your most recent ad shows red numbers. Every amateur emotion floods your system. Fear of giving back gains, regret about timing, anxiety about whether the trend is ending. The professional knows this is exactly when patience pays the biggest dividends. Pullbacks within trends are normal, healthy, and necessary. They shake out weak hands, allow institutions to accumulate more shares, and create energy for the next leg higher. This isn't passive buy and hold investing, it's active trend following that requires constant monitoring and binary decision making. Either the trend structure remains intact, or it doesn't. A story from Livermore's archives illustrates this perfectly. In 1915, he pyramided into Bethlehem Steel as World War I. Orders poured in, and steel demand exploded. His initial position at $45 proved profitable quickly, as the stock ran to $52. He added at the $52 breakout, then again at $61, and once more at $78. Each addition required fresh confirmation and was protected by trailing stops below recent consolidation lows. Each pullback tested his nerve, but he held through every consolidation that held above his trailing stops. The stock would rise for weeks, then consolidate for days, then resume its advance. Amateur traders would have taken profits on the first 20% gain. Livermore built a position that eventually returned over 500% as the war boom accelerated through 1,916 and into 1,917. His largest position size occurred in his best-performing trade, systematic position building that concentrated capital in proven winners while maintaining strict risk controls. Stop management becomes the hinge that turns pyramiding from bravado into discipline. After each successful ad, relocate your protective stop to a logical structural level that invalidates the most recent leg. By ratcheting stops under each newly formed base, you convert trend energy into capital safety. You're always one failed base away from flat, keeping drawdowns shallow. Professional pyramiding also considers portfolio heat. Cap total open risk under 6 to 8%, and single name exposure under 25% of equity, even after profits. Correlation matters. 4 breakouts in the same sector often behave like one oversized position. When volatility spikes or market breadth deteriorates, slow your ads or skip them entirely. The maxim that builds wealth: add to winners, never losers. This approach requires discipline most traders never develop. It demands fighting every natural instinct about taking profits and cutting losses. But it's the only systematic way to build substantial wealth from trading, because it aligns your position size with market reality rather than emotional comfort. But how do you know when the party's over? Next, I'll reveal the exit signals that protect profits without choking healthy trends, the final piece of Livermore's wealth-building system. The final test of every great trader isn't getting in. It's getting out. More fortunes have been lost by overstaying great trends than by missing them entirely. The market doesn't ring a bell at the top, but it does whisper warnings to those who know how to listen. Exit timing separates the wealthy from the almost wealthy, the professionals from the perpetual strugglers. You can execute perfect entries, pyramid positions flawlessly, and still destroy your account if you don't recognize when the party is ending. Think about the dot-com collapse of 2000 to 2002. Traders who rode Cisco from $10 to $80 felt like geniuses. Those same traders who held from $80 back to $8 learned that trees don't grow to the sky. The market gave multiple warnings: failed breakouts, distribution patterns, climactic volume spikes. But they ignored every signal because their winners had become part of their identity. They weren't trading positions anymore. They were married to them. Amateurs make 2 fatal errors that stem from identical psychological weakness. They either take profits too early, scared of giving back gains, or they hold too long, watching winners turn into losers. Both mistakes spring from the same problem: no objective exit plan. They trade emotions instead of signals, hope instead of evidence, stories instead of structure. The early profit takers convince themselves they're being disciplined. They see a 15% gain in 2 weeks and think, better lock this in before it disappears. They take their small win and watch from the sidelines as their former position runs another 50%. Picture the amateur who buys at $50, watches it run to $65, a solid 30% gain, then sells from fear. The stock continues to $100. They won the trade but left 75% of the potential profit on the table. The late exit crowd makes the opposite mistake with identical psychology. They watch their winner pull back 10% and rationalize. Just healthy consolidation. They see it fall 20% and convince themselves, great companies always come back. Consider the trader who bought at $50, rode it to $100, then held as it fell to $90, $80, $70. Still profitable, but greed whispers, it'll come back. They watch it drop to $55, giving back 90% of their open profits. Both groups trade emotions rather than following objective market signals. Professional traders operate from systematic discipline. They accept that getting out is never perfect. You'll rarely sell the exact top. The goal isn't perfection. It's preservation of capital and capture of the middle 60% of every major move. They understand that trying to squeeze every dollar from every trend guarantees giving back substantial profits when trends inevitably reverse. Livermore learned exit discipline through brutal experience that nearly destroyed him multiple times. His biggest losses often came not from bad entries, but from perfect trades he held too long. Cotton in 1907, wheat in 1897. Trades that should have made him rich instead nearly broke him because he ignored the tape's warnings. The cotton trade illustrates this perfectly. Livermore had built massive positions as prices soared on crop shortage fears. His pyramiding system worked flawlessly as institutional. Money drove prices higher week after week. But when the trend showed fatigue, failed breakouts, distribution patterns, climactic volume, he ignored every warning. He had become emotionally attached to being right about cotton's direction, rather than responsive to cotton's actual behavior. When reversal came, it was swift and merciless. The same institutional money that drove prices higher began selling aggressively. The momentum that carried his position to massive profits now carried it to devastating losses. He learned that exit discipline matters more than entry precision, and that the market's capacity for both greed and fear exceeds any individual's ability to predict or control. Here's your trend death checklist. You don't need all signals, but 2 or 3 together demand immediate action. First, structure breaks. After months of higher highs and higher lows, the first lower high and lower low appears on your campaign time frame. This isn't temporary pullback within trend. It's the first crack in structural foundation supporting the entire move. When a stock making higher highs for 6 months suddenly fails to exceed its previous peak, then breaks below its previous low, the trend's integrity is compromised. Picture a stock consistently finding support at its 20-day moving average and bouncing to new highs. Suddenly, it breaks below the 20-day MA, rallies weakly to retest from below, creating a lower high, then falls through its previous low, creating a lower low. This sequence violates the established uptrend pattern and signals shifted institutional sentiment. Second, failed breakouts. A move to new highs gets completely reversed within 48 hours on heavy volume. This classic bull trap sees the stock push past previous resistance, enticing buyers, only to quickly reverse and close back below that level on even higher volume. This tells you institutional money that pushed it higher was immediately met with overwhelming selling pressure from other, large players. It's like a boxer throwing a powerful punch, but getting countered immediately with a stronger blow. Third, climactic action. Range expansion becomes unsustainable. 20% moves in single sessions. Signal exhaustion, not strength. These parabolic moves represent final blow-off phases where public speculation reaches fever pitch. Everyone talks about the stock. News is overwhelmingly positive. Even your barber gives stock tips. While exhilarating, professionals understand such extreme moves are unsustainable. They represent the last gasp of buying pressure. with institutions using retail FOMO to offload positions at inflated prices. Volume patterns provide final confirmation. During healthy trends, volume expands on moves in trend direction and contracts on pullbacks. When this reverses heavy volume on pullbacks, light volume on rallies distribution is occurring. Professional money uses rallies to exit while retail money uses dips to enter. Your exit protocol must be surgical in precision. On first warning signs, tighten stops to the most recent pivot point. Move your protective stop to just below the most recent swing low that supported the last advance. This gives the position room to breathe while protecting against structural breakdown. If you're up 3R or more, meaning open profit equals 3 times initial risk and momentum stalls, take 25–30% off the table. You're converting paper profit into realized gain while maintaining exposure to continued upside. When 2 warning signals appear together, exit the entire position. No negotiating with hope. No waiting to see what happens tomorrow. Profit taking equals position size times 0.25 to 0.3. Profit taking equals position size times 0.25 to 0.3. Let's make this concrete. You buy ABC at $50.20 on confirmed pivotal point break with volume 180% of average. Your stop sits at $47, risking 0.75% of equity. Price runs to $59.80, and momentum stalls with open profit exceeding 3R. Following protocol, you sell 30% of shares and trail the stop to $56.20. 2 days later, price pushes to $61.40, reverses and closes below $59 on climbing volume first warning. Next session forms lower high and closes below $58.20. Second warning. 2 warnings trigger full exit at approximately $58. Hours later, a downgrade hits and the stock gaps to $54.90. Your rules protected gains and psyche. Here's the paradox that destroys most traders. The same momentum that carried your position higher will carry it lower once the trend breaks. That stock gapping up 15% can gap down 25% the next day. The institutions buying on the way up will be selling on the way down, and they won't wait for retail to exit first. When big money decides to exit, they execute massive selling programs with precision, often before retail traders realize what's happening. Institutional selling creates downside momentum that mirrors upside momentum that created your profits. But selling often happens faster and more violently than buying. Fear is stronger than greed, and panic selling accelerates faster than methodical accumulation. A trend taking 6 months to develop can reverse 40% of gains in 6 days when institutional money heads for exits. The maxim for the ages: when the reason for the trade is gone, be gone. If you entered because of trend alignment and pivotal point confirmation, exit when trend structure breaks and pivotal points fail. The market owes you nothing beyond what you can systematically extract through disciplined process. Master this complete process: trend identification, pivotal point entries, pyramiding, and objective exits, and you'll never again be part of the 90% who lose money fighting forces beyond their control. You'll capture the middle portion of major moves while others argue with momentum. You'll exit with profits, while others ride winners back to losses. You came seeking Livermore's secret to big moves, and you found it wasn't magic, it was discipline. The brutal truth is simple. Cut losses fast when wrong about direction. Size positions small when uncertain. Wait patiently for trend alignment. Add only to winners, and exit on objective signals, not emotions. Master this identity shift from predictor to follower, and you'll capture the middle of every major trend while the majority fights forces they'll never understand. If this framework resonated, the next lesson on risk management, mathematics, calculating R multiples, position sizing formulas, and portfolio heat will give you the precise tools to implement these principles with mathematical precision.